Today, we're taking a deep dive into Eve Energy, a major force in the global lithium battery sector. Now, this company presents a real paradox for the market right now, a stark disconnect between its recent stock performance and its underlying profitability. So, let's deconstruct the factors driving both sides of this equation.
First, let's look at what the market is seeing. In a recent 40-day period, EV Energy's stock price shot up by an incredible 44.3%. To put that into perspective, the broader market index gained only about 2% during that same time. That's a massive outperformance, and it signals some incredibly strong positive sentiment from investors.
But here's where the puzzle really begins. This market enthusiasm stands in sharp contrast to the company's actual fundamentals. Their most recent semi-annual report showed a year-over-year decline in net profit of nearly 25%. So there you have it, the core divergence. Huge market growth happening at the exact same time as a significant drop in profitability. This leads us to the central question: what's behind this divergence? Our analysis suggests the market is looking past the current numbers, focusing instead on two primary factors that support a much more optimistic, forward-looking view: technological leadership and global expansion.
The market's positive outlook seems to be built on two strategic pillars, or what you might call moats. The first is the company's leading position in next-generation battery technology. The second is its aggressive push to expand its manufacturing footprint across the globe. Let's examine each of these.
The company's tech advantage really centers on two key product lines. You've got the 46 series large cylindrical batteries, which offer a really competitive mix of energy density, cost, and safety for high-end electric vehicles. Then there's the Mr. Big Cell, engineered specifically to drive down the long-term cost of large-scale energy storage systems. Both of these represent a significant leap forward from previous technologies. And this isn't just theory. The commercial demand is already substantial. Eve Energy has secured a massive 574 gigawatt-hours in letters of intent, mostly from major international automakers. An order book of this size provides a lot of visibility into future revenue and really helps to de-risk the huge investments they're making. This tech leadership is being backed by a smart globalization strategy. Key projects include a new plant in Hungary to serve European clients like BMW right on their doorstep, plus a multi-phase expansion in Malaysia. This kind of localization is designed to shorten supply chains, navigate geopolitical trade risks, and simply be closer to their customers. Okay, so that's the optimistic narrative of technology and expansion. But it doesn't account for that recent drop in profits. So now, we need to turn to the other side of the coin, the financial and operational headwinds that are currently impacting the company's performance. The DuPont analysis gives us a very clear breakdown of the company's return on equity. As you can see from the data, asset turnover and the equity multiplier have stayed relatively stable. The real story, the principal driver of the lower ROE, is the net profit margin. It has contracted significantly, falling from 9.66% in 2022 all the way down to 5.7% in the first half of this year. This chart just provides a stark visual of that margin compression. The downward trend really highlights the core financial pressure facing the company, and it's what creates that dichotomy with the market's optimistic valuation. So what's behind this squeeze? It really comes from two directions. First, you've got an intense, industry-wide price war that is compressing the price per watt-hour. And second, the company is spending heavily at the same time, investing in both R&D for its new technology and the huge capital costs for its global factory build-out. To sum it up, the key risks are clear. Intense price competition, rising financial leverage with a debt-to-asset ratio now at 65%. It's also taking them longer to collect cash, with accounts receivable days now up to 95. And then you have the external risks, geopolitical trade policies, and the relentless technology race, especially with competitors pushing into areas like solid-state batteries. Given this complex picture of immense opportunity on one hand and significant risk on the other, how should we assess the road ahead? The key is to focus on a clear set of indicators that will tell us whether the company's ambitious strategy is truly succeeding.
So here are the key forward-looking things to monitor: the quarterly gross margin trends for their core battery segments, the progress and cost control of their overseas factory construction, the rate at which those large intentional orders convert into firm contracts, and, of course, shifts in global market share. On top of all that, the price of key raw materials like lithium carbonate will remain a critical variable to watch.
This whole analysis really distills down to one central question. Eve Energy clearly has a technological advantage and a global strategy that the market has rewarded. However, it's facing this simultaneous margin compression and significant execution risk. So the fundamental question is, can its technological leadership successfully navigate these near-term headwinds to deliver sustainable long-term profitability? The resolution of that tension is what will define the company's trajectory from here.